over a 15-year period, 91% of Canadian active equity fund managers underperformed their benchmark.
The average investor barely exceeded the inflation rate over that time frame, 2.4%. So why in the world were they underperforming all those major asset classes? And again, it comes down, I think we've got a great podcast today. It's really kind of hitting a lot of different people. We've got some discussion points that are really good principles that are right for everyone. It doesn't matter whether you built up significant net worth or whether you're just beginning the journey. I think everyone will appreciate some of the topic areas that we're going through together. So I'm looking forward to today's podcast.
Yeah, I am too. I think they all had different age groups, right? So this is podcast number 14, I think. And I'll just throw the title of the podcast out there. So 10 easy money habits that will make you wealthy. And I think
is that like get rich quick schemes kind of stuff?
Yes, exactly what it is. So basically, awesome. These are foolproof habits.
Like buy gold or crypto.
Yeah. I think that's most of the points we have here. Is the first one is to buy crypto at its low point and just ride it up.
It's easy,
buy
right?
low. I think number 3 is buy low and sell high.
Okay.
You had that. Anyway.
Excellent. Great. Well,
no, they're a little bit better than that.
Excellent.
All right. So we can move into pre-show key items here.
Yeah. There's no upcoming events, although a couple of weeks ago we did do our first Monday briefing, and we'll continue to be doing that. So it's just a matter of lining up some guest speakers. And so for those of you watching the podcast, if you haven't already reached out to us to be on our subscription list, make sure you do that. If you go to the show notes, there's a link back to our website, and you can just send us an email, Humphreys Wealth Group, hwg@asante.com, and we'll make sure you're on the distribution list for the next Monday briefing, which is kind of like, what do the markets do? Special guest speaker. We'll do a financial planning topic, do some discussion points on markets where relevant. And, we've been encouraging Q&As. So it's a chance for you to interact with us and ask questions, maybe give some of your own insights. So look for that communication. But if you haven't heard yet, you can go to our website and you can reach out to us that way.
Yeah, it's on Zoom, right? So you can ask questions live as well.
Yeah.
Something that there were some questions regarding tariffs and all that fun stuff last time. So
yeah.
Also, I think you had some pretty amazing YouTube videos recently. Do you want to talk
about
those?
We had one video recently. If you go to the YouTube channel, how to turn your retirement fund into a steady income stream. And kind of we use the analogy of a paycheck, thumbnail paycheck. So that seemed to resonate with a lot of people. How do I go from working full time to getting a paycheck? And the paycheck analogy, I think, really fit for a lot of people. So it's a very practical YouTube video on the conversion of money from your RSP to a RIF and getting steady income. And then we did a kind of a video that just looked at generating $7,000 a month of net income, starting at age 55 or 60, 65 or 70. And we calculated how much capital you need to save at each of those ages. So if you're going to think about retirement and wondering how much you need to have set aside, that video will give you a helpful frame of reference.
Yeah, that's really good. Personal anecdotes. You can take it away from here first. You have a race coming up.
Yeah, actually, I got 2 races coming up. My brother and my buddy Wayne and one of my brother's friends in Regina, we're going to head out to Lumsden, Saskatchewan for a gravel race out in Lumsden. So we're going to put pain and suffering on ourselves. And then 2 weeks later, we're heading off to, okay, don't hold this against me, everyone. We seem to be elbows up here against the Americans, but we're going to South Dakota for a gravel race down there as well. So we're looking forward to beating up our bodies and having some nice refreshments afterwards. So pretty excited about it.
Yeah.
And I think you're doing something down the States.
I'm in the same boat. Yeah. I'm going down to the Fargo Marathon May 31st. So I'm going down on the 30th, I think, or maybe 29th. I don't know exactly. Should know that.
And then you got a big goal, right?
Yeah, I'm hoping to qualify for Boston. So I need a 255, sub 255 if I want to give myself a chance.
Wow.
Which is a pretty fast marathon. So I got to hold 4 minute and 7 second kilometers for generally if I wanted to go under 255. So that's going to be, I'm going to go out at 407s. I'm either going to blow up around 35K or a miracle is going to take place and I'm going to go under it. My time last year, I did the Manitoba Marathon was 3:17. I'm going to absolutely blow that out of the water. I've been training way more.
Yeah, you've been doing a lot a lot of
So
painful intervals and stuff, right? A lot of
yeah,
pain.
so my mileage is way higher, between like 80 to 95K a week. And there's actually structure to my training finally. Last year it was just mileage but no structure. So I know I'm gonna blow my last PR out of the water, but that 255 I want pretty bad. That'd be pretty cool to go to Boston. I mean, either way, eventually I think I'll qualify. This is only my second official marathon, so um,
But it probably feels like running the 100-meter dash for you after doing the 100K run to Gimli, Manitoba last year. So
yeah, I don't know. The marathon's such a hard distance, right? Because it's not short, but it's also not really long once you
yeah,
once you're running fast enough. So it's just such a hard distance. It's so hard. So there's a lot of fast training involved there. Like when I was training to run 100K, every run workout was slow. Like I was not running fast ever. And so it's just a completely
yeah.
different animal. And so luckily I have a coach to help me through that. But what else? That's pretty much it. After that, I want to sign up for longer stuff in the late summer, but we'll see what happens. Maybe I won't qualify, and then I'll want to hit another marathon later in the summer. So I'm leaving that door open a little bit. But hopefully I qualify first go here.
The one thing that Josh is mentioning, he's right in the middle of finishing his beer league hockey season. So
Yes.
his team is actually in the finals the evening we were doing this podcast, and
What is this?
he
April
keeps
27th? Yeah.
yeah he keeps getting pucks blasted in the direction of his ankles, hitting his ankles. So that's kind of slowing you
Well,
down a
I
little bit.
sacrificed my body for my team. So
Yeah,
yeah, I've been taking a lot to the ankles, which isn't good.
yeah.
I couldn't run for a full week 3 weeks ago from a block shot. So that one I did not intentionally try to block. I was trying to actually run away from the puck, and the guy just completely
Got you anyway.
missed the shooting lane and smoked me in the leg. So
Wow.
that's what happens, I guess, when you try to run away.
Well, I guess everyone's pretty enthralled by our personal anecdotes.
Yeah.
Okay, let's lean into the agenda, Josh.
All right. So the agenda is, like we said, we're gonna head off some habits that theoretically compound over time. Well, that do compound over time, and can really lead to growing wealth. And that doesn't mean just getting a lot of money, but just wealth in general. Like little habits over time, obviously
Yeah,
compound, right? And so I
yeah,
think all these things lead to accumulation of good money habits, which lead to accumulation of money over time.
yeah.
And yeah, I'll move to our first slide here. So the first one here is setting up automatic savings. So when I was kind of prepping for this episode, this didn't seem like a really big habit, but I know in my own life and a ton of people that I know, we know that we should set up things in a systematic way, but we just don't do it. And so for years after I turned 18, I was like, okay, I'm gonna open up a TFSA. I'm gonna set up a pack, pre-authorized contribution, and start contributing. And it took me years to finally get that going. And once you have it done, it's great, and it's amazing how quickly you can start accumulating savings once you have that set up, and you don't even notice it. You just pick an amount that is not too large, and it just leaves your account, and you get paid. And yeah, it's a small thing, but it's a really important thing. So what you should do is kind of view it as you're paying yourself first. So before you have your other bills, you set out this amount that comes into your account, and that's what you're setting aside for yourself in the future. And
Yeah.
This
Yeah.
allows you to have a systematic approach to building wealth instead of relying on motivation and reminders. Because we'll even have good intentions, right? We'll be like, hey, well, I'll just move the money over, right, when it comes into my account. But it just doesn't happen like that. I even struggle with that now. I'll get like an ad hoc amount of money in my account, and I'll just forget to move into my savings. I'll forget to transfer to my investment account. And so having these systematic approaches, I think, it's so much more important than we think it is.
Well, I've got, this whole topic reminds me of a book that came out a number of years ago called The Wealthy Barber.
Hmm.
And Chilton was the author, and he's still out there doing his thing, doing social media and podcasts as well. And, just pay yourself first, 10% if you can, every month. Have a deduction right against your payroll if you've got a group RSP, or get it to your investment account. I've got clients, and in fact, one of the clients said they were together, they were brothers, and they were together at a family event, and they both have multiple $1 million in their investment accounts. And they are a good example. They were reminiscing. He said, "Remember that we went to a seminar that Shaun did. This is going back 30 years ago, and they seem to recollect that I made the comment, well, you don't have a lot of money, but you got a lot of potential. So I don't think I said that. Maybe they thought that. And so they set up monthly contributions and they were very dedicated. A good chunk of their wealth today was built up through just consistent savings. And so we've got lots of clients that have built up sizable portfolios just by being consistent month after month, year after year, being disciplined in their portfolio strategy. And we'll talk about that a little bit today. And it really compounds over time. And so it may even be better than buying crypto. Who knows? Maybe the strategy we'll talk about will be have a higher probability of success. The other thing that happens with incremental savings, and is a little bit different than this topic, is the topic of systematic rebalancing. Making sure you've got these automatic levers. So when you get preoccupied, or you get stressed out, or you get distracted, or you're not sure what to do, systematic plans, whether it's systematic savings or systematic rebalancing to realign your investment mix as markets fluctuate, are really great disciplines that are powerful over time.
Absolutely. All right, let's move on to number 2 here. Lifestyle creep and acting on a budget. So I'll just read the slides. So often spending growth matches or exceeds income growth. So one way to combat this, create a monthly budget. I use Every Dollar. I know my siblings use an app called Monarch to track that. I think people feel like it's more than it is. It feels like a commitment, but it's really not that crazy. This helps you to anchor your lifestyle growth below your income growth. I think that's really hard to do. We all think we will do that. We all think we will not increase our lifestyle spending as our income grows, but it just happens. Even just like just changing your social circle. So all of a sudden your spending matches your social circle and you're doing the things that people around you are doing. So you're spending like they are. And our intentions aren't actually, or often are not, what we act upon. And income increase isn't necessarily a reason to change your lifestyle. So I don't know if you have any thoughts on that.
I think it's probably one of the most important principles that you outline, I think, in this discussion today is you need to be intentional, think about what your goals are, and then reverse engineer, set specific targets every month towards those objectives. So a really good example of this is when we talk about retirement planning. So for some of you watching this podcast, you're either retired or you're about to retire. Part of the budget process is, because you've mastered this, but the biggest question we get from people is, how much can I afford to spend? Or Shaun and Josh, can you put together some guardrails? So what level of spending can I sort of have within a range? So I've got the basic budget, and then I've got guardrails that I can have some flexibility with, but I shouldn't go above those spending levels too frequently. And then if you're younger, one of the best things you can do, in our estimation, and clients have gotten great value over the years from this, is and reverse engineer your retirement income plan. How much do you need to save when you add in maybe a pension at work or government benefits? How much you need to save every month, so that by the time you get to whether it's 55 or 60 or 65, your retirement date, you'll have sufficient capital to retire on. So no matter what else you do in your cash flow planning, if you just do that, your long-term income security is looked after. And that's a great peace of mind exercise, right? This is the one thing they need to do, and if they do it,
Yeah.
they'll be well ahead over the years.
Yeah. And yeah, shoot us go to our website and shoot us a submit our page there. We'd love to connect on that because, I mean, it's like I said, we always intend to get these things planned out, but we just don't. So it's good to leave it to someone else to help us with that.
Yeah, there's two plans, right? So if you're in your 30s, 40s, 50s, your planning would be more focused on accumulation of assets and your investment strategy, right? Which is different than someone that maybe is within 5 years or 3 years or 1 year from retirement. And now they need to begin really tweaking that strategy. And now they're getting close to the deaccumulation phase. And so those are great plans to get in place so you have confidence and peace of mind.
For sure. All right. This one's really good. Number 3, stop trying to be special in relation to investment performance, obviously. It's good to be special in other ways. Average is not average. So I guess I'll just preface what I mean by this. So chasing market beating returns often leads to underperformance. And we think that for us to be the good investors, we need to outperform the market. But that's not really how it works. The problem is most people underperform the market. So over a long period of time, they have really poor returns. So if you just Yeah, so I have the second point here. Average market returns over the long term will likely put you in the top 10 to 15% of investors. And so it's getting the average market return does not mean you're going to be an average investor over the long term. And we often kind of mess those two up. Fees, excess trading, market timing, overconfidence, all so many other biases will only lead to worse outcomes. And if you there's this I don't know if you call it a study, but I guess it's a study put out by S&P SPIVA. So Standard and Poor's indices versus active.
Yeah.
There's a spelling error there. Anyways, so over a 15-year period, 91% of Canadian active equity fund managers underperformed their benchmark. And in the US, the long-term performance rate is similar. Over 85% of US large cap active fund managers underperformed the S&P 500 over 15 plus years. And so especially if you're in that younger age group, right? Your time horizon's over 15 years. And so getting average returns over a 25, 30-year period puts you in an incredible position. Yeah.
Yeah, no, exactly. And when you look at again, some of this gets back to just psychology and human nature, right? So, um, it is such a compulsion that drives us. And we experience this all the time with clients. And, we have these conversations. We try to invest time in education and talk about the principles that will lead to the highest probability that they'll experience their financial goals and outcomes. And one of the principles, particularly when it comes to investing, and this presumes that the client has the appropriate portfolio, that we've done our homework in terms of if they have risk assets like high quality stocks or ETFs in the stock market, that we've feathered those in properly. And we've got a solid plan. And when the markets aren't necessarily going in the direction we'd like them to go, the compulsion is to fix the problem. So in every other area of life, intervention, action, change, fixing the problem is the driving force behind things. And one of the ironic things when it comes to investments is don't try to go in and fix a problem in the midst of market volatility. That's not a high payoff strategy. I'm not sure if you have anything to add to that, Josh.
Well, yeah, I mean the impulse to go and try to fix something assumes that there's something wrong, right?
Yeah,
And I think
exactly.
it comes with education to realize when stocks when there's a market correction, stocks are down. That doesn't necessarily mean, unless you just made some really bad investments, right?
Yeah,
It doesn't necessarily mean something's wrong, and so it doesn't necessarily mean you need to change something. That's what you signed up for when you decided to be an equity investor.
yeah.
That volatility is what you're getting paid for. So yeah,
Yeah, and we don't want to dismiss volatility. Like it's
yeah,
tough to go through it. So we don't
yeah,
come across being, it's not serious when it happens to us, but
for sure. Yeah,
we want to make sure that you're acting with discipline.
absolutely. All right, you had a slide here. Is this related to?
Yeah, this is just again, most of you, kind of watching or listening to this content, you might think that no, you're smarter than the average bear. Probably you are, and you're going to get the averages or better than averages. So this box that's on the slide basically is looking at the broad U.S. markets and really every major asset class. So on the left hand side, you've got REITs, you've got oil, then the S&P 500, EAFE index, which is a global stock index, gold, bonds, real estate. This is US data from 1994 to 2013. It's older data, but this data hasn't changed. The average investor barely exceeded the inflation rate over that time frame, 2.4%. So why in the world were they underperforming all those major asset classes? And again, it comes down to psychology. It comes down to, unfortunately, a lack of discipline or rigor in terms of how they're managing their portfolio or sometimes their behaviors. Again, it's not easy. Equity investing can be very tough. And all asset classes go through fluctuation. So the next slide sort of drills down specifically to equities. And again, it's an older slide, but it's very instructive, 1992 to 2011. And you're looking at the average stock fund return in Canada over that time period was 8.2%. It's all equity mutual funds available to Canadian investors. And on the right bar there is the average stock fund investor return, 3.5%, not the 8.2%. So again, why would all those funds average 8.2 and the average return 3.5? They called it the investor behavior penalty. It gets back to behavior. And if when watching the podcast or listening to it, if we just step outside the discussion a little bit and just be self-reflected, we've all had those moments. And even seasoned investors, when there's lots of volatility, there'll be a part of them, having this impulse to, maybe this time's different. Maybe we need to pull money out of the markets right now. No, If that's what you need to do to have peace of mind and sleep at night and all those things, okay, that's what you need to do. But is that the right behavior in that moment? No, it's not. And in fact, history tells us it might be a good time to be adding to your portfolio, not pulling out, as tough as that is. Josh, do we have a lot of clients running into our office with checks to add to their portfolio in the markets that are going through a lot of downward fluctuation?
That would be a negative.
No, and that's all almost all advisors experience, right? That doesn't happen. That should be the behavior, but it doesn't. That's why systematic rebalancing, we talked about that before, is so important. We don't have any clients calling us and turning off the systematic rebalancing. So they're moving money from cash or bonds back into stocks when the asset mix gets out of whack. And now we're buying back in the market at good value at that point. So yeah, it's a tough thing to do, fighting against human nature.
Yeah, for sure. All right, number 4. Now, spend money on things you truly value. I'll be honest, like I didn't come up with this one, obviously, but I've seen this around and I really agree with it. And I want to reiterate as part of our 10 habits that will make you wealthy. It's I think it's really important to spend. I'm learning this more and more as I get older, is to spend money on things that you actually want to do. I think when we're growing up, often we make the same purchases as the people around us, and not always those things are not always the things we want to do, but we just end up doing them because we're influenced by other people. So aligning your spending with your personal values and not trends or status. Um, Take time to intentionally evaluate your purchases, whether that's going on a trip that you don't really want to go on, but you just, everyone around you is going on it. There's actually a pretty interesting study where they found that money actually, well, in their study, if money boosts happiness when spent intentionally and not impulsively. So, for example, if like now when they say spend, I think they include in spending like giving money away. And I think there's a pretty strong argument for how that can increase happiness. But I'll just read a little summary of this study. I thought it was pretty cool. So the study investigated whether the age-old phrase "money can't buy happiness" is always true, and whether it can buy happiness when spending aligns with a person's core personality traits. So it basically explores whether the emotional return on spending depends on how money is used, not just how much is spent. So they found that personality match spending is correlated with a greater life satisfaction. People who spend more money in ways that reflect their natural personality report higher levels of well-being, even after controlling for total income and spending. Number 2, the match between personality and spending is a better predictor of life satisfaction than total income. That one's pretty cool. So how you spend your money is a better predictor of satisfaction than how much money you have. And so they go on to say, in fact, the personality congruent spending explained more variance in life satisfaction than income itself, challenging the notion that more money always equals more happiness. I think generally we know that more money doesn't equal more happiness. Once your base expenses are paid for, it's pretty hard to get more satisfaction out of more money. But I think, yeah. And then 2 interesting facts from the study. So extroverts were happier when they spent more money on going out, while introverts felt better when spending money on quiet hobbies. Obviously, that kind of makes sense. And the data, so they pulled this from actually 76,000 people, or real world bank transactions paired with personality data. So it's one of the few studies that used actual spending behavior instead of reported data. Sorry. Yeah, 76,000 real world bank transactions, not people. I said people before. So yeah, I thought that was pretty interesting. I mean, it makes sense. So
Yeah, it
anything
makes
to add to
yeah,
that?
it makes yeah, it makes intuitive sense as well. Like I think for a lot of couples, right, it's a great compromise. But as you're spending money and doing things in a family situation or a couple situation is trying to find win-wins. If you're going on a holiday, the extrovert wants to do some things and the introvert wants to do different things. You try to find a nice compromise between the two. So both of you have a great holiday.
For sure. All right. Number 5. This one, so biased.
Yeah, like when we talk about this, it always, like self-interested, and you gotta, of course, you're gonna talk about this because this is the work that you do. But I think we can talk about the importance of financial advice or advisors. We can put our hand on our heart because the data is really, really clear. Financial advice, professional advice adds value, and yet you can watch the Quest Trade commercials or others of that ilk, and all they seem to say is that are a drag on performance. And I would be the first to say that if you're not getting value for fees paid, then yeah, you don't want to have superfluous costs and not getting any value. That's obviously a pretty clear thing. But professional advice, particularly in the area of financial planning and direction and coaching, is different than that, right? So if you're comparing paying 1% on a mutual fund and 5 basis points on a ETF, okay, maybe the low cost ETF's better. But if you're then talking about how to integrate investments into your portfolio to achieve your retirement income funding goals or whatever it might be, it's true advice. And so we'll just in a minute talk about a study that's pretty well known, at least with advisors, and maybe not so generally known in the public, called Advisor Alpha, and how advisors can add value. But at the heart of it is this idea of coaching. And there's no one watching or listening to this podcast that wouldn't agree with what I'm about to say. What does a coach do? So a coach will sit down with you, try to understand what your goals are, your pain points, your current position. And once they have an understanding of that, they'll analyze that current position and then take a look at, the gaps or opportunities that are there that can be exploited or leveraged off of or improved. And then they'll integrate strategies, ideas that will help you get to, from where you are to where you want to get to. They'll help you implement through both accountability and encouragement. And then they will provide that ongoing feedback loop and then do an assessment and review to see how your progress has been. Are you ahead of plan? Are you at plan? Are you behind? What adjustments do we need to make? You do that review, and then you reestablish a revised plan. Now, that coaching works in the diet industry, the health industry, and education. It works in finances because a vast majority of people tend to get preoccupied. Life gets busy, they get disinterested, human nature gets in the way of them achieving their goals. And so, coaching is a really, really powerful model.
For sure. No, that's really good. Okay, awesome. Next slide, I think you're going to dive into a little bit about the Advisor
Yeah,
Alpha study.
exactly. These are the characteristics around the Advisor Alpha study. It was a collaborative study between Vanguard, one of the largest manufacturers of ETFs on the planet. They probably manage in excess of $7 trillion, and they collaborate with Morningstar, and they put the research together. And Vanguard has this interesting opportunity because you can go out in the U.S. as an example, buy their ETFs directly, same in Canada, or you can have them acquired through an advisor, where the advisor will provide recommendations, construct the portfolio, and work with the family. So you have advised households working with advisors and non-advised households. And so they could look at the data purely from a performance standpoint as to the difference in outcomes between advised households and non-advised. And then they superimpose on top of that some psychographics and other surveys and data that allow them to also assess confidence and other psychological profiling. And what they found was that advised households consistently were having better financial outcomes and peace of mind experiences working with their advisors. Now, from a financial standpoint, they identified 5 main categories that were adding value. These are categories that the advisors and their teams are doing for the clients. The first one is behavioral coaching, which was things like when the market's not doing well, giving clients perspective, helping them to get through life events or transitions effectively, when they're having to make financial decisions in the midst of grief or opportunity or excitement. The advisor plays, sober second thought and, just a good context for the discussions. And that coaching experience was adding 1.1 to 1.5% additional value to the family's net wealth over and above what the actual securities were making for the family. Now, that was an average over extended time frame. Didn't happen every year because some of the transition points or market volatility were not an every year thing, but they were so significant over extended time periods that cumulatively it was adding over 1 to 1.5% per year to the client's balance sheet. You then had comprehensive wealth planning. So they found that families engaged in overall financial planning were getting another 0.5 to 0.6% additional wealth, asset allocation rebalancing, profit taking, making sure the portfolio is being properly monitored, upwards of 0.5% additional value. Tax management for some families was critical, particularly with business owners, clients with non-registered assets. That was a key area, could up to 0.8% per year. And then portfolio deaccumulation strategy is a critical one. I know for our office, we get contacted all the time for people thinking about retirement. and want to know how can they deaccumulate to produce income in retirement the most tax effective way, right? And that was adding additional value to these families. So cumulatively, the average value added per year to the advised households was 2.5 to 3.5% per year over and above the security positions that were generating growth. A very, very significant payback. But a lot of that was being driven by just the disciplines of each of those activities and the coaching and accountability loop provided by the advisor and their team. And for most people, they get great value and utility. Now, if someone's a do-it-yourself investor, they just can't, give up the reins on the planning. Maybe they're not used to paying professional fees to other consultants or advisors. They've never seen the value in that. That's a pretty big ask for some people, particularly if they're a do-it-yourselfer just by temperament. But the data really is clear about the utility of having a coaching relationship with advisors. I know it comes across as being biased. It's what we do. But if you're actually looking at these behaviors, Joshua, and you're going, this is not just about what investments are in the portfolio. I wouldn't say that's the least important part of it, but it's not the most important. It's just part of a piece of multiple layers of activities that should be going on.
For sure. No, I totally agree. It does sound biased, but it's because it is. Everyone's biased. It's whether or not you acknowledge those biases.
Good point. Yeah.
All right. Number 6. It might be a little bit quick, but reading financial statements. So reading your bank statements, reading if you want to get into financial statements of the companies you own, their stocks, be my guest. But I think it's a really important thing. It's just paying attention and having, like I say here, staying engaged and intentional. And obviously, this is one that I myself I could be better at. So catching fees, poor on the investment side. So look at your investments. What are some poor performing investments? And then asking yourself, why are they poor performing? Is it just because the market's down, or are they actually really bad investments? I make a bad decision here. Or like a spending leaks with your credit and debit cards. Like, are you paying for subscriptions? This gets kind of relating to budgeting. Are you paying for subscriptions that you're not even using? And I'm definitely guilty of that. But just looking over your finances, you're looking over your statements and looking at the bills that are popping up.
Yeah.
It's a really important habit to have. I mean, it's obviously super simple. It sounds obviously look at your statements, but I think it happens less than it should.
Yeah, and I can add to that by saying there's two activities that as a practice we do for clients that I think gives great clarity, and it ties into the reading financial statements. So part of that is when we do a retirement income plan or a financial plan for a client, we're always giving them a current balance sheet. So we're always updating their financial assets, their real assets, any debt that they might have, and arriving at the current snapshot of their balance sheet. And that is really a barometer of how you're allocating money. So at the end of the day, your net worth statement or your balance sheet is going to be a reflection of how you're handling your money, whether it's debt reduction, adding to your portfolio, growing your financial assets. It's a great benchmark. And for a lot of clients, we particularly see this in the retirement planning area, is they want to see how their net worth or balance sheet's changing year by year. And are they on track? What do the plans say? And are we tracking to have a balance with the plan or ahead of plan? A huge peace of mind. One of the things that we will do for retired clients, and we're doing a little bit of this right now. I mean, with market volatility, one of the things that many clients ask us to do is to update the retirement income planning forecast. Or they'll ask us, in 2025 of that forecast, what were you projecting would be the ending value of our balance sheet and our financial assets? And, if they're tracking ahead of that number, huge peace of mind. When the economy is going up and down, the market's going up and down, there's a lot of uncertainty. So that whole planning piece is important. And then even from an investment standpoint, we have a statement, and it's not unique to our firm. I think other firms do it as well, but clients complain, I think, of getting too much paperwork from all their dealers. And so there's just all this information that comes, and sometimes it's really difficult to see exactly how the portfolio's done. And we do this change in financial position on their portfolio every single year. We go, here's what you started with at the beginning of the year. Here's what you added. Here's what you took out. Here's what your dividend distributions and price appreciation or depreciation on the assets was, and then what your net return for the year was, and then your ending value. And so that gives them a very clear picture as to whether they're ahead of plan or behind the plan or on plan. Because then I say, well, we got a simple return of, 5.8%. and then they go back to the retirement income planning, and the plan said you need to get 4.8%, let's say, a peace of mind. And when I say to them, this is what your balance sheet was projected to be at the end of the year, and they can see that currently their balance sheet's a little bit ahead of that, right? So reading your financial statements, like you said, is important at the micro level, but it's really important as well at the macro level to give peace of mind that you're tracking in the right direction. We look at your financial situation much like a business person or a CEO would look at their corporation or business they're running. We use those financial statements to assess progress and fine tune on the way.
Yeah. Awesome. All right. Number 7, say no to FOMO. So, oh, hold on a second. Number 7, say no to FOMO. So, fear of missing out. Now, this kind of relates to spending money on things you actually value. Obviously, that's the second bullet point there. So, determine what you truly value, then don't spend money on the other stuff. But I think this also goes to your goals, right? What are your financial goals? And once you define and figure out what your financial goals are, then you can figure out what you should and shouldn't be spending money on. But I think a lot of times we spend money on things we don't really want to do out of fear of missing out on something. And it's just over time we get better at that. So learn to miss out. So in reality, you're probably not missing out on anything. And whether that's activities you don't want to actually do, hot stocks or market trends, I think that's a really important part of this is missing out on the trendy investment. Well, just trendy investments in general, whether that's NFTs or
Mar-
coins.
marijuana stocks.
Yeah, right. And it's hard to say no to that because we think, oh well, other people seemingly are making all this money. Like I don't want to miss out on that, right? But often it's not exactly what it's painted to be. I know with like a lot of meme coins, they're just legal. What's the word? I'm forgetting the word for it, but they're just a chance for people who are able to pump up the value of the coin by using their influence. So they'll make a tweet about it, the coin will go up, they own it when it goes up, and then they just dump it right at the top, trashes the value, and everyone else who'd bought it when they tweeted about it gets screwed, right? We see this stuff all the time.
Well,
But
yeah, they're
and
like they're like pump and dump stocks. There's nothing to them, right? It's pure.
yeah, and you see this and you go, how do people fall for this? But it's I don't know, like it's almost understandable. Like you maybe like the influencer, you like the person, and you don't think that they would do that, and you fall for it. But
But
it's just being able to see what it really is.
But I think the missing out driver, which you list here, is huge. That psychological driver is massive, and it's
Yeah,
always operating in the background, right? We don't want to miss out. We don't want to be the one that at the cocktail party didn't take advantage of this hot thing that everyone seemed to seize upon. So,
yeah,
um, I think that one, like hot stocks and market trends, as a team, that's one of the biggest ones that we see. We don't really see it with our clients because I think they're pretty well educated in terms of philosophy, or they wouldn't be
hmm
dealing with us. But for new folks we come in contact with, that's a question that comes up all the time. And
hmm
I often will say, listen, we're about investing, and we'll talk about a slide in a minute about constructing a policy statement. We're about putting the laws of probability in your favor to hit an outcome and not take on unnecessary risk. Now, if you want to
yeah,
jump on hot stocks and market trends, go for it. We do have clients, we call it core and explore, right? So they've
hmm
got the core portfolio, it's like their pension plan, and it is very, very precisely calibrated and managed to drive towards a certain outcome over time. And if they want to have explore, where they want Bitcoin or they want extra amount of gold for whatever reason in the portfolio, they want to speculate on securities, fine. But just know that that may not be true investing. That's just speculating, doing
yeah,
things on a hunch, right?
yeah. But I think for a lot of people, they think that speculation is investing.
Yeah.
It
Yeah.
feels like investing. And I mean, I get it, but just know the distinction between those there. Okay, number 8, reinvesting windfalls instead of spending them. So I just kind of had a couple points here. So using mental accounting bias to your advantage. So there's this behavioral bias called mental accounting where we treat money differently based on where it is. So for example, people I think this is a pretty common one, but they'll be saving money while simultaneously having credit card debt. Um, and what they should be doing is paying off that credit card debt first. But in their mind, like they're setting this money aside and they're going to deal with the debt different later. But really, it's just a mental thing, right?
Yeah.
And you can use that to your advantage if you use the mental accounting. You get a windfall. You get the government sends you back money. and you treat it like it's not actually yours, and you just invested or something like that. You can use your biases against yourself or for your own benefit. And then so my second point there was try to use or treat bonuses, refunds, tax returns as not your spending, not your money to spend. And these small amounts can, over a 25, 30-year period, have a real impact due to compounding. And there's this thing called found money trap. So unexpected income that feels like a bonus instead of normal earnings, because it feels like extra money, fun money, found money. It results in being more easily spent on meaningless things.
Yeah.
So yeah, it's just being intentional and cognizant of what you're doing with your money, which is way harder, way easier said than done.
And I keep, closing loop back onto planning here. So we do have clients for often some of these things, right? Inheritances, gifting from older parents,
Hmm.
buyouts, stock options, different things that come into their life. And before they allocate the money, what they want to do is, okay, so if I took this money or a part of it and I leveraged off things like maybe I have some unused RSP room or unused TFSA room, or I add that to my portfolio as part of my retirement plan, as an example, what is the ripple effect of that? And what if I don't do it? What's the ripple effect? And that's a really good exercise to go through, right?
Hmm.
And so our software will actually do a net present value calculation and show you in dollar amounts the difference between those two outcomes. So some people will look at that and go, "Oh, that's not that big a deal. I mean, I'm okay with the outcomes of my current planning, and I'm going to spend the money and feel okay about that. I'm going to do some lifestyle spending or travel or whatever it is, take the kids to Disney." And other people will look at that and go, "Holy smokes! Like I can retire 3 years earlier if I just allocate that windfall to my plan," right? So I always come back to planning because it just sets proper context.
Yeah. I mean, planning is really at the base of everything here. All these fall under planning. So that's a good point. All right. Number 9, careful who you take advice from. So, and that includes us.
It does include us. Um, yeah, so I think that particular chart really gets into a discussion on just understanding the difference between a fiduciary and non-fiduciary. So what I mean by that is, vet who you take financial advice from, formal education, track record, they do matter. I think about our situation as a team. We've been doing retirement income planning for 30 years. We've helped hundreds of families make that transition. We've learned an awful lot over the years, right? And so there's a huge leverage point for people to take advantage of that experience. We just have this pattern recognition, and when we look at a file, we see certain patterns right away. I think that one of the really big things when it comes to advice giving is my experience, example, cutting my teeth at Royal Trust and RBC or Royal Bank, and the bank and the RBC continues to be the dominant charter bank in Canada. And when you walk into the bank, you can get advice. And there's a lot of well intentioned people working for the bank charged with the responsibility of giving advice. Here's the problem: they are compensated to sell the bank's products and services, and they are employees of the firm. So it sets up right away a conflict of interest. They're not true fiduciaries, and it's going to be difficult for them to give you true advice. And so that's the first thing: is are you dealing with a true fiduciary? How are they being compensated? And generally speaking, the way you want to assess that is how are you paying for their services? So if you walk into an advisor's office and it's the firm that sponsors their license or whatever and paying their salary, that's not a true fiduciary likely. If you're dealing with an advisor who is charging you a fee for a plan or doing a fee for service investment portfolio strategy and charging you directly, then they're likely a fiduciary. So you're aligned. So you're paying the advisor for advice that's objective, that does not have conflicts of interest, and you're walking down the same path. You're on the same side of the table in terms of the planning. And if you're not dealing with somebody like that, there's the potential of misalignment,
Hmm.
conflicts of interest, biases creep in. So that's one area to just think through. Are you dealing with a fiduciary? The other issue is related to designations. Right? So you've got a financial planner, which I am. You also have, chartered investment manager or chartered financial uh, manager or CFA, chartered financial analyst. And each designation has a sort of focus, right? So when we meet with clients, what we do is we lead with planning. So if you're looking for a retirement income plan, a financial plan, and trying to pull all the pieces together, then dealing with a financial planner who has a designation in the area is likely a really good idea. That's what they're trained to do. That's their focus. Now, we handle investments as well, but what we do is we typically will partner with firms where we're dealing with CFAs and other people that work with us collaboratively to construct portfolios. That's what they do full time every day. And then we use their expertise to construct a portfolio that aligns with the planning, right? So O1 designation is not going to hit all the points, right? It might be a collaborative effort where you hire a financial planner to develop the plan to help construct the portfolio. And we'll talk about one document that's really important for that. And then the financial planner will go out and they might headhunt CFAs or different firms that will help with the management of assets. And so that would be one of the ways of looking at it.
Yeah, that's really good. I think you hit off all the points I was gonna talk about there. And you've kind of referenced it a couple times what this special document is, and this
The
is number
special document.
yeah,
Yeah.
this number 10 is
Trying
that.
to get to it. Yeah.
Alrighty, so make a plan, and within that plan, so your long-term goals and your investment policy statement. So you can take it away from there.
Well, sometimes referred to as IPS, if you hear someone say that. The investment policy statement is really just a document that summarizes really what your goals are. So typically, what the investment policy is going to do is it's going to go, okay, on your financial plan, and your financial plan is given guidance on how much risk you're prepared to take on your portfolio, right? So you can have some clients that 80% of the portfolio, they're perfectly comfortable having risk assets. So high quality stocks, paid dividends, or stock ETFs. Other clients, they don't want any risk assets in their portfolio. So the first thing is define the client's appetite for risk, and that's going to have an influence on their plan. And it also will drive how much potential return is going to happen on the portfolio then. So that risk and return drives the investment mix. And that investment mix or allocation will be constructed with cash equivalents, bonds, real estate, and stocks. And stocks could be big cap, mid cap, small cap stocks, and they can be stocks geographically weighted, Canada, US, and global around the world. And so the investment policy summarizes all those things in one document. And then it also talks about rebalancing. It talks about income and liquidity needs. It talks about assessments when that happens on the portfolio. And so it aligns both you and your advisor in one common game plan, which is really, really critical. So where you get problems between the professional who's working with a client and the client is they get misalignment because it wasn't proper communication or the client was assuming certain things that weren't correct. And the investment policy statement makes sure that everyone sits down around the table, defines the mandate, what the goals are, and what the goals that the advisor and their team are shooting for on behalf of the client. The client's educated, understands it, signs off on it, so that after the fact, there's never a meeting of, well, I didn't think you were doing that, or I'm surprised about that outcome. That should be discussions that happen before. They shouldn't be happening during or after. Now, some of this also is, I know in our practice, Josh, you've heard me talk about this, we get referred clients, and those clients have already a very strong level of trust in us, even though we haven't met them yet, because there's been a strong referral. And sometimes they'll say, "Listen, if you're good enough for Sally, you're good enough for me, and whatever you think's appropriate, I'm going to go with those recommendations." And what we say is, "That's great. However, there is a process we need to take you through. There's a certain level of understanding you need to have, so you're never surprised. This is a collaborative effort, and you can't just be a pure delegator. You need to be part of the process and understand basic principles. So there's, like I said, nothing comes about as a surprise in terms of this experience." So that's a very long-winded description, but hopefully it helps a little bit, Josh.
Yeah, that's really good. No, I totally agree. It's really important to outline those things, and also there's difference when you talk about risk, right? There's a difference between someone's capacity for risk, like how much
Yeah,
risk they theoretically could take, and
yeah,
their I think I'm saying this right, but their
yeah,
ability to take risk, right? So someone's could be young, it could make sense based on their age, and they're getting income. They have a portfolio. It could make sense to be 100% equity, but they just can't stomach it, right? And so the optimal portfolio for them based on your IPS is not what theoretically the literature says they should be in, right? For their highest long-term outcomes. And so it's really good to figure that stuff out on a document with your advisor, come to an agreement and be on the same page, or else it could get tricky down the line.
Well, yeah, like it's like I'll give you a couple of examples. So you're again you're at the barbecue or the cocktail party, and you're talking about life, and all of a sudden, there's a conversation on the markets or your portfolio, and you're listening to this conversation, and you're thinking to yourself, I'm not getting anywhere near those returns on my portfolio.
Mm,
Like, what is my person or team doing here? And so you get a little bit concerned that maybe you're not getting the advice you should be getting, or that's not the right approach. You're wondering why you're not getting the performance. Well, hopefully what you're going to do in that moment is you're going to go back to your team and you're going to express the concern. And what should happen is, well, and this is the toughest part of the discussion. Do you know what your friend or friends were investing in? What was driving that performance you thought
mm,
was so good? And hopefully you have at least some basic information about what was going on so that you can actually break with your advisor. And your advisor might in that moment say, well, okay, we need to go back to our investment policy here because you clearly are a very conservative investor. You've developed a strategy for you that allows you to achieve your financial goals, getting lower returns because we're going to be conservative. We signed off on that. We talked about it. We got a whole strategy around that. So the strategy was not about putting 80% of your portfolio in growth investments, which is what these conversations were about. Now, if you want to redefine your goals and redo the plan, and now you have an appetite for taking on more risk, that's great. We can do that. But let's revisit. It may be doing well now, but that portfolio could go through some serious downside volatility. So if that happens, are you going to be committed to the plan? So the investment policy really allows people to properly frame these discussions because those discussions happen all the time. And so people have no context, or people talk about their winners, they never talk about their losers, and they don't,
100%. Yeah.
the structure's not there for the conversation.
Yeah. I just had a conversation with a friend about this. He was looking at his portfolio returns and he was going, why are they so bad? And he was comparing it to pretty much an all equity fund, right?
Yeah.
And the reality was he had told his advisor that he didn't want a lot of risk. The advisor had put him in some theoretical inflation hedges, like he had some gold and stuff like that.
Yeah.
I have my opinions about that, but um, and then he went back and realized like that's not exactly that's not what he wants at all. But I guess he didn't really understand it when he had first talked about his goals. So I mean, it gave them a chance to readjust things and then move more into equities and go from there. But yeah, he was literally that exact situation happened where he was looking at his portfolio returns and comparing them with someone else's and going, this advisor must be bad.
Yeah.
And I was vouching for his advisor that probably had to do with his investment policy statement, or is it? I didn't know who his advisor was, but yeah, it's fine.
Yeah, and the policy statement, and when we're talking about this formal document, it doesn't necessarily have to be. It can be intuitive. It's that
Yeah.
card, right? Well, I'm conservative and I need this money in 3 years. And through a conversation, the advisor is going to assess what would be appropriate from a security standpoint.
Mhm.
That can be a policy statement, based on that interaction. Hopefully, notes have been taken. So yeah, it is very much a process of both education, understanding, spending time with your advisor, and your advisor spending time with you to make sure there's alignment in terms of what you're trying to achieve. And when you don't do that, then it can blow up for everyone, and you just don't want that to happen.
100%. All right, I think that is all the points. We will go to the post show now. Post show items I have
Oh,
here. So
show. Okay.
yes, exciting stuff. So little episode recap. Um, I think the biggest takeaway and what all the points go into is taking the time to be intentional about your goals,
Yeah.
talking to someone who you value their opinion of, and that they have credentials and a track record to show a good performance, I guess, not just on the investment return side, but performance with other people, and developing a plan, sticking with that plan over the long term, and then benchmarking and going back to the plan continuously in times when maybe the markets go up and down. I think all those points that we hit off, those 10 points, all fit into that.
Yeah, yeah,
Um,
exactly.
okay.
And then, for some of you, we might be prompted you to go, I don't have a plan, or I don't think I have a plan that's adequate to tie these things together. So if you go to our website, there's investment retirement planning resources. We have something called the retirement planning resource bundle, and that's for anyone that's within 5 years of retirement, really relevant. If you're not yet retired, maybe a few years away, but you go, I think I'd like to have a financial plan that helps me kind of coordinate, like, how aggressively do I pay down debt? How much do I need to save? what do we need to do to make sure that I'm tracking in the right direction? That might be if you're in your 40s or 50s, maybe your 30s, and you're getting some traction financially. And then others of you, you might be really thinking about retirement. So if you go to the website, there's an opportunity to book a free 30-minute complimentary call to learn more about our fee-for-service financial planning services.
Absolutely. Yeah. Definitely book a call. That's pretty much it. So if you made it this far in the video, make sure to like, comment, and subscribe. We'll have other episodes and a bunch of, I think you're probably going to have a couple of videos coming out on the channel regarding retirement planning this
Yeah.
week.
Yeah.
So definitely be on the lookout for that. And I think that's it. I think we'll catch you. I think the next episode is number 15. So we'll start prepping for that very soon.
Okay, great. Thanks, Josh.
Awesome. All right. Catch you guys in the next episode. Bye-bye.